Okay, let's talk about one of the biggest financial decisions you'll ever make, getting a mortgage. We're going to crack open the official rulebook that governs the whole process. So you're buying a home? It's a huge deal, a complex game with some pretty high stakes. But who actually writes the rules? Well, it turns out there's a whole detailed playbook out there, and it's designed specifically to protect you, the borrower. You see, every mortgage has a rulebook, and the most important chapters are written by three crucial federal laws: ECOA, RESPA, and TILA. We're going to follow the entire real-world journey of a borrower, from the second you start looking all the way to after you get the keys, to see how these rules actually play out. All right, let's dive into Section 1, the rules of fairness. And what's really interesting is that these rules kick in before you even fill out an application. It's all about creating a level playing field from the absolute start. This is where the Equal Credit Opportunity Act, or ECOA for short, comes in. It lays down some really clear, non-negotiable rules about what lenders are forbidden to consider. They can't use any of these personal characteristics you see here, things like race, religion, sex, or marital status, to make their decision. Period. And this is where the rubber really meets the road. On the left, you've got the stuff that's fair game: your income, your credit history, the hard financial numbers. On the right, that's the stuff that is completely off limits. The law makes it crystal clear. The decision has to be about your wallet, not about who you are. And hey, even before you've chosen a lender, the Truth in Lending Act, or TILA, is already working for you. You've seen those ads, right? A super low interest rate that sounds amazing. Well, TILA says if they're going to flash a tempting number like that, they also have to clearly and conspicuously tell you the other important details. No misleading fine print allowed. Okay, so let's move on to Section 2, applying and disclosures. Now we're getting to the rules of transparency. You've found a lender, you're ready to fill out the paperwork, and this is where the Real Estate Settlement Procedures Act, RESPA, steps onto the stage to make sure everything is out in the open. So, what exactly makes a loan application complete in the eyes of the law? Well, under RESPA, it's these 6 specific pieces of information. Now, why does this matter so much? Because the second you provide this info, a clock starts ticking for the lender. It's a really big deal. And that clock? It's a 3-day clock. The moment they have your complete application, they have exactly 3 business days to give you an estimate of your loan costs. The whole idea is to make sure you're not left in the dark, wondering about all the potential fees. Now, RESPA governs all these things called settlement services. It sounds technical, but it's really just a catch-all term for everything that needs to happen to close your loan. We're talking appraisals, title searches, loan processing, you name it. RESPA's whole purpose here is to prevent hidden fees and shady practices among all these different providers. And this quote from the law itself, this gets right to the heart of RESPA. What it means in plain English is you can only get paid for a service you actually performed. It's all about stamping out illegal kickbacks, like a lender getting a secret payout just for steering you towards a particular title company. All right, on to Section 3, getting the decision. We're talking about the rules of objectivity. Your application is in, the lender's reviewing it, and you guessed it, ECOA is back in the picture, making sure that evaluation is fair and based only on your creditworthiness. But what happens if the answer is no? Denied. It can be incredibly disappointing, for sure, but the law says you can't be left wondering why. You have rights. If you're denied credit, the lender has 30 days to send you what's called a notice of adverse action. This isn't just a simple no thanks. It has to explain the specific, legitimate reasons why you were turned down, based on factors like your debt-to-income ratio or credit history, not any of those prohibited reasons we saw earlier. So let's fast forward to the closing table. You've been approved, you're ready to sign that huge stack of papers. This is Section 4, the rules of finality. And RESPA is working hard here to make sure there are no expensive, last-minute surprises waiting for you. Let's talk about something called an affiliated business arrangement. Say your mortgage broker recommends a specific title company and, oh, by the way, they happen to own a piece of that company. Well, RESPA says they absolutely have to disclose that relationship. And crucially, they also have to tell you that you have every right to shop around and use someone else. Even your escrow account, the one for taxes and insurance, is regulated. Lenders can't just demand you deposit an excessive amount of cash at closing. They're only allowed to collect what's necessary, plus a small, legally defined cushion. And they have to give you a full statement breaking it all down. The deal is signed, you're so close to getting the keys, but we're not quite done. For certain loans, the law gives you one last powerful protection: Thanks again to TILA, the Truth in Lending Act. Welcome to Section 5, Post-Closing Protections. 3. That's the magic number. It's the number of business days you have to completely change your mind and walk away from certain types of loans, absolutely no questions asked. This is called the right to rescind. Think of it as a 3-day cooling-off period. Now, this usually applies to refinances and home equity loans on your main residence, not a home purchase. It's a safety net, designed so you never feel pressured at the closing table and have a real chance to back out if you have second thoughts. When you boil it all down, a huge goal of TILA is to give you this one super important number, the APR, the annual percentage rate. It's the great equalizer. Because it bundles in not just the interest rate, but also other fees and charges. It's designed to give you the true cost of the loan so you can make genuine apples-to-apples comparisons. So there you have it, ECOA, RESPA, and TILA. They're the 3 pillars of protection for anyone getting a mortgage. But these laws are pushing 50 years old. And with the world of lending and technology changing so fast, you really have to ask, how will this rulebook adapt to protect the next generation of homebuyers?